Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's March 21st. I'm friend Curzio, host of the Wall Street Unplugged podcast, why I break down the headlines and tell you what's really moving these markets. Man, March Madness is insane. Can't find a better name, right? March Madness. The first number one seed to lose in the first round, which is Virginia. Not only seen upsets, but blowouts of some of the greatest teams. And North Carolina getting destroyed. Wasn't even close by Texas A&M. That game was in Charlotte. Okay, UNC. Say, wow, these guys played bad and were able to win. That's why I like them so much. But they played bad, and Texas A&M played amazing. Yet Arizona gets annihilated in the first round by Buffalo. Cincinnati, one of the greatest teams out there on defensively, they're up 20 with 9 minutes to go. The probability, I'm not kidding you, the probability of them losing that game, 99.9%. So you have 99.9%. That's the actual. That's a fact. That's the numbers they had with about 9.5 minutes to go. So the probability of them winning the game, right, was 99%. 99.9%. And they lost. Up 20 minutes. Oh, up 20 points with 9 minutes to go. Michigan State losing to Syracuse. That game was in Detroit. And Syracuse, a team that shouldn't even be in this tournament. I mean, you could argue, well, look how far they went. Doesn't matter. You have to earn that. You have to earn that right to get in the tournament. You have Boeheim that bitches every year. So this year he said, okay, let me improve our schedule. So you look at their strength of schedule, but look at they played good teams, but lost to every one of those good teams. Were they 19-13? They got killed. They only had one good win this year. It was against Clemson. Their other next best win was Louisville, and they didn't even make the tournament. They lost to North Carolina, Duke. They lost to everybody. And Oklahoma State should have went in easily over Syracuse. And so Notre Dame, you can make the case. It's like 5 teams. But they're playing well, and they deserve it. Again, you can't look at, wow, they're beating. I mean, I think Oklahoma State could have made a similar run. Same with Notre Dame. And they're making the best of it. But Michigan State doesn't score in the final 6 minutes of the game. I mean, you're Michigan State, one of the best teams. Xavier up 12 in the second half against Florida State. And Florida State looked like, they were fighting with each other, arguing. It looked like it was going to be a 20, 25-point blowout. They just stopped playing. They wind up losing. And Loyola Chicago beating Tennessee. And holy cow, unless you have Villanova, most brackets are completely busted. And my sleepers from last week were Texas Tech, Gonzaga, Kansas State. All those were in the Sweet 16. I'm not going to pat myself on the back because I had North Carolina winning it all, and they're gone, which is very surprising. I like Kansas State to go to the Final Four if and only if they get their star player back. Dean Wade, he didn't play the first 2 games, and they still made it this far. And they played horrible last game. They played terrible. Oh, I can't believe. They still won because they played a crappy team. They have a week's rest. I think they get an easy schedule. I play Kentucky, who I don't think is that good. Again, they have to have their best play. This guy's amazing. I seen him play against Kansas. Lit him up. Fantastic Dean Wade. He has to play. He was on the floor just for a couple minutes, I think. But he just really is not healthy. He says he'll be back next week. My ultimate sleeper right now is West Virginia. Told you how good their defense was last week. I saw West Virginia play a ton this year. I think they had the best defense in the league, better than Cincinnati. But they could never really score. And they were up against Kansas, at Kansas, by like 12 or 14, with I want to say 4 minutes left, and blew that game. But it's a team that can't score. Well, they just played Marshall. It is Marshall, but they scored 94 points. I think they averaged something like 60-something maybe. And if they could score 75 points, they're going to win the tournament. They'll beat every team because they're not going to give up 75 points. They gave up a lot of points on Marshall because it was garbage time. They blew them out and they scored 94. If this is a team that gets hot, they are that good to win. Don't be surprised. Because I know they're off your radar. But in mid-January, they were ranked as the number two team in the nation behind Villanova. They were ranked number 2. And I followed Big 12 because of Kansas. I know all these teams. So I knew Kansas State was great. I knew Texas Tech was great. These guys are amazing. And right now you can bet $100 win $1,600 on West Virginia to win it all. So this isn't like some sleeper team. They always had a great D. If their offense clicks and they get hot and they're able to score more than 75, 80 points, they're not going to give up that much. They are the best team. They'll beat anybody because they can guard Villanova. They can play great game. They might lose the next game if they're cold, but don't be surprised if they're there. I think it's a very good bet based on risk reward. Now, I covered March Madness a lot. This is an investment podcast, but I do have a great educational segment coming up. It is about the NCAA tournament, but it's how it relates to stock picking or how you can become a better stock picker. Okay, I'm going to merge all this stuff together. It's going to be really cool. I promise. You don't need to be a college basketball fan or sports fan to appreciate it, but seriously, this segment is going to make you money. So please listen to it, even if you don't like college basketball, because something happened in a tournament that's very important that relates to investing, and it's going to teach you how to become a better investor. Before we get to that, an awesome interview set up with Steve Koomar. So Steve's a former derivative trader at Goldman Sachs. He's the editor of Vigilante Investor. It's his newsletter. It's an awesome newsletter that I read personally. I don't read a lot of newsletters. I just feel like I only like to read stuff where I'm learning things, learning something new. I do that by reading Vigilante Investor, maybe 2 or 3 other newsletters. Not a bad thing, a good thing. I'm just telling you the truth. So I wanted to bring Steve back on because his latest issue was awesome, which goes into more details about tariffs and how this crazy hot mess that we're seeing every day, these trade wars are going to happen, and basically the actual economic implications that it's going to cause. Well, Steve explains how it will lead to one of the biggest bull markets ever. I'm talking about annualized gains of 15% over the next 10 to 15 years. Koomar is not some crazy guy. He has amazing stats to back this up. Whether you agree with him or not, listen, because you're going to support all this stuff, and it's very interesting what he said, whether you agree with it or not. I love when everyone makes crazy predictions out there. The Bitcoin 1 million, the market's going to crash 80%. Nobody really backs it up. It's all BS. They don't have the numbers. They don't have models. When you listen to this, he's going to be able to back it up, and it's very interesting. I'm not saying you're going to agree with it or not, but it's fantastic once you listen. Also, he's going to share his favorite sector with you that's about to see a huge break. It's not uranium or gold. It's actually a beat-up sector that's dirt cheap, and a lot of stocks in that industry are seeing their strongest earnings and free cash flow growth in over 4 years. So what do you have? You have cheap stocks in an industry that expects to see strong growth over the next few years. That's always exciting to me. You really don't see that in this market. You usually see high growth, very expensive stocks. You don't see cheap stocks. It's cheap stocks and a weak sector or market like gold, uranium. This is a sector that's seeing strong earnings, free cash flow, everything going higher and higher and higher, expect to do better and better and better, yet the stocks are still cheap. So he's going to share that sector. More important, he's going to highlight his favorite stocks within that sector that are likely to surge, even double, over the next 6 to 12 months. So enough of me building this up. Let's get to my interview with the one and only Steve Koomar. Steve Koomar, thanks so much for joining us again on the podcast.
Great to be on. Thanks for having me.
No worries. I appreciate you doing this interview because I know you're not at your house, you're not your home base, but you're on the road. But I really appreciate it because you're one of the newsletters, Steve, that I actually read. I don't say I read a lot of newsletters, and it's not that I'm, putting anybody down but I like to read newsletters that I learn, like I learn something new from. And that's why I love reading it, especially your macro thesis on some of these things and how it relates. It's like a top-down approach and how it filters down to the stocks you recommend. And your last issue was on tariffs. I just spoke about tariffs. So I got a lot of comments, a lot of feedback, most of the positive, some are like, whatever. But you went more in depth than I did. And when I read it, it was fascinating when you went to VATs and stuff like that. Could you talk a little bit about that issue? Because it's fascinating. It's going to lead to a whole bunch of questions I'm going to ask, which is going to result in market predictions, stocks you should invest in, sectors you should invest in. But let's get everyone on the same page first and talk about that issue that you just wrote. It's fantastic.
Thank you very much, Frank. And first, let me say it's very humbling to me that you read my newsletter, that you find that it has value to you, because you really produce some of the best research that I've ever seen anywhere. So
I
thank
appreciate
you very much
that.
for that compliment.
Thank you.
Yes, and I listened to your podcast last week. I always listen to your podcast, and I thought you gave a tremendous analysis on the tariff, on what Trump is doing, what the Trump administration is trying to do with the tariff, and really kind of that it's really not that threatening, and why it's not that threatening and where it could produce some real value and outcomes out there. I thought it was a great analysis. My most recent issue was about the steel tariff and that very specific part of Trump's agenda, and it's but it does relate to the bigger issue of how trade works and how it is taxed. And I think that the issue that is rarely discussed, the only place where I've ever seen it discussed in policy areas was when the Republicans first got elected in 2016, and they were talking about a border adjusted tax. And the issue was that the United States needed the border adjustment tax in order to compete with the value-added tax that's out there in the rest of the world. And so the value-added tax, which everybody has except the United States, basically has a value-added tax or something similar to it, like a general sales tax, acts like a tariff at the border. When somebody imports a car to the U.S., there are no taxes. There's a very small tariff, but there are no taxes. But if somebody imports a car in Germany, they pay the full value of the German value-added tax at the border, which is about 20%. So it acts like a 20% tariff there. But in the U.S. is the only country in the world, only major trading country in the world that has no value-added tax. And so that puts the U.S. in an incredible trade disadvantage towards everybody else, because if you're trying to export goods, you have excess goods you want to export someplace. The U.S. is one place where it's 10 to 20% cheaper to get to the consumer than any other place, because there's no tax on the border. There's no value-added tax that's added at the border, and it's really made the U.S. An international dumping ground. And I mean, you can go down the list. I mean, Canada is one of the lower tax rates. Their sales tax is like 11 to 15%, but China's 17%, Germany is 19%, Mexico 16%, Russia 18%, the UK 20%. These are all taxes. It's kind of like a hidden tariff. And when goods hit the border there, they get that surcharge of about 20% across the board at all those countries. In the United States, there's no similar tax to that. And so it's really feel it in steel, because there's a lot of global excess supply of steel, and that all ends up coming to the U.S. Because there's no tax in the U.S. when it hits the border. And really, it's the same case for all goods. It's really probably the biggest reason why the U.S. has this enormous trade deficit across the board. Really, with just about every trading partner, the U.S. has a trade deficit, and it's because we don't tax consumption like everybody else does in the U.S. And with regards to the steel tariff, I think it really doesn't do much more than equalize the taxes at the border. You know, if it's got some problems with it, because there are some isolated consumers that could get punished, like an automaker could get punished some because they're going to have to pay a higher price for steel in the United States. And an importer of autos in the U.S. isn't going to have that higher cost of steel. So there's probably likely to be more steel that comes into the U.S. in the form of finished goods like cars or other fabricated car parts or other heavy equipment. But nonetheless, in the reality, it's in this one very small sector of the economy, which is steel. It's really kind of equalizing the border taxes that occur across different countries.
Yeah, and Steve, you did a great job because you actually put a chart in there, right? And this is where you went into more detail than I do about the value-added tax, and you have slash the GST, which is the general sales tax, and you have it combined. And just like you explained, you have Canada 11 to 15%, China 17%, Costa Rica 13%, Egypt 14%. We have no value-added tax in the U.S., as you explained, right? So exporters can sell at a relatively high price and still compete for you as consumers. So the playing field is not level. I'm going to ask you a question before we get into the details, which is really cool because you have a whole economic analysis based on this of why it's going to backfire and be really good for the stock market ultimately. But why do you think? I mean, is it just the media? Is it just because I don't see this anywhere? Okay, and again, guys, I say this all the time because it's difficult. Put your politics aside. Okay, maybe Trump could have handled this a different way. Maybe he could have threatened a little bit more, and just like we did with, I don't know, what was it, 13 Days? Remember that book in the movie? Where we negotiated, where we moved our missiles from Turkey, but you can't tell anybody we did that, and then you move, so the Cuban Missile Crisis and stuff. There's ways to handle this behind closed doors instead of just announcing it publicly, maybe handle it differently. But why is this not being explained every place? Because if you read almost anything on both sides, it's almost like just we're destroying the country. Global trade is going to end, and this is horrible. This is going to start a recession. It's going to blow up. Like you're hearing all these fears out there. How come no one's actually telling the story of how everyone else is really ripping us off and we just want to level the playing field here?
It's a really good question. I think there's a vested interest in maintaining the status quo. Over the last 70 years of free trade, which has largely come, at the sponsorship of the United States. There's many industries in the United States that are dependent on cheap imports, and so most of the industries in the U.S. do not want to see any change in the status quo. For instance, when they were talking about a border adjustment tax in the initial tax bill that Paul Ryan was proposing, it was something like a 15% tax that would have acted like a value-added tax at the border for imported goods, and that's all it would have affected. But the retail lobby went crazy over it, and there are two senators that are very closely tied to the retail industry, Tom Cotton from Arkansas, who sponsored Walmart, and David Perdue from Georgia, who was executive of several retail companies in the past, including CEO at Dollar General. And these guys, marshaled the forces, and they blocked any real serious consideration of that sort of a tax. And that just tells you that there are some really strong vested interests. Some people would call it special interests, whatever you want to call it, that really are dependent. Their current setup, their current business operations are dependent on the current status quo of globalization and cheap imports into the U.S. And they have their friends in media, they have their friends that are lobbyists, and that's the story that gets told, is the story of globalization and the benefits of it. And it's interesting. Everybody likes to talk about the worries of a trade war, and the last time there was a really serious trade war was during the Great Depression, the Smoot-Hawley tariff. And, arguably it did worsen the Depression and worsen things from the U.S. But at that time, the U.S. started that trade war. And it was a really stupid trade war to start because the U.S. was running a trade surplus with all these other countries around the world. And so the U.S. had the most to lose from a trade war. Well, now the U.S. has a huge trade deficit. All the countries with the surplus are the ones with something to lose. And so, I don't think there's likely to be a trade war because I don't think anybody can afford to lose their massive surplus that they have going with the U.S. It's not over like one narrow, small industry like steel. I just don't see that being a big issue.
Now, you bring up a good point here. So we're going to get to the sectors and stocks, guys. And I love explaining like the macro part of it to get everyone on board. And sometimes that can be boring for people, but it's very important to understand this because this leads to, what sectors are going to benefit and ultimately what stocks are going to benefit. So that's why I wanted to cover that at the beginning. But you say tariffs are going to have a limited impact on inflation, and you provide the numbers just on the steel industry. And then you go more into it, which we talked offline about how, not only could this stuff backfire, but it could lead to something which will create a sustainable market. So could you explain how we get to these tariffs and what's going on now to that point of where you say, hey, you know what, this could be good for stocks in the end run because people think there's going to be inflation, but when you look at the numbers, there's not really going to be inflation, which you provide all the data for.
Yeah, the primary metals industry, which includes steel production, iron ore, copper, all that, is about 0.3% of U.S. GDP. If you had a 20% increase in prices of all those primary metals, which isn't going to happen, it's not going to be that much. But let's just say worst case, it was a 20% increase in steel and copper and all those prices applied to 0.3% of GDP. You know, that amounts to less than 0.1%, about 0.05% inflation rate. It's almost nothing. It's a rounding error in the calculation of inflation for a year. So this will not affect inflation in any measurable way. However, it will what it will do is it will help the U.S. steel industry. It will allow these companies in the U.S. to increase their capacity utilization. They've got enormous amounts of unused capacity, and as they are allowed to sell their steel at somewhat higher prices, it won't be a lot higher because there's still a lot of competition out there. They'll be able to increase their capacity utilization, and the combination of more volume and somewhat higher prices is going to mean significantly higher profit margins for these companies, particularly in steel and in iron production. And those companies, they're going to be the biggest winners. And it's really not going to affect the overall economy. I think that there will be, automakers in the U.S. are going to have to some higher costs. There's about 2,000 pounds of steel in an average car. At 50 cents a pound, that's about $1,000 a car. So if you get a 10 to 20% increase in price of steel, that's going to amount to $100 to $200 a car. That's something that the U.S. car companies are going to have to deal with and suffer from. However, on the flip side, they just got an enormous policy benefit from the tax cut, the corporate tax cut, which cut 14% in their tax rate from 35% to 21%. When you consider that GM makes about $4,000 per car profit on average, that amounts to something like $560 per car of added profit that they didn't have before. So it won't be hard at all for them to eat that $100 to $200 extra cost of steel. They're making a lot more money on the tax cut than there will cost them to pay for in steel. And the other thing that GM and all the other car companies and all the other steel users will do is they'll find ways to optimize in the supply chain. They'll import more parts. They'll find ways to import more steel goods that are semi-finished or finished steel goods. And that will offset some of the cost increase for them. So they're not going to eat the whole, not the entire cost of the tariff isn't going to be embedded in the car. They're going to find ways to cut corners and reduce some of those costs. But yeah, I think the steel companies will be the biggest beneficiary.
And sure. Thanks for breaking down those numbers, because those are hard to find as well. Because when you see, how much per car and $4,000 for profit, and how, the tax cuts is going to be a little over $500, it's going to be $100 to $200, say $150. You are going to see prices be raised a little bit. But like you said, when you said it's a rounding error, it is a rounding error. If you look at the economic data, it says basically, there's leave room for this much. It could be off, but it's within that. So, which is interesting. So, I want to move on to politics a little bit, because you talk about, there's just one thing, and you talk about taxes. This brings into everything. I'm not going to get personal with politics here, but it relates to what we're talking about, because you're saying that a political economic revolution, this is like a once in a lifetime thing. And you're saying it's creating one of the best long-term bull markets that you could see, and it could last for a very, very long time, where you're not too worried about inflation. In the past, We have cycles of lowering debt. Inflation always goes lower. Like, you've done a lot of homework on this. Explain it, because it seems to us that not just to us, but to me especially, that's a different opinion what we hear out there, where people believe the market's toppy. We see inflation coming, higher interest rate. You're saying that, okay, we're not going to see as much inflation as you think, and you know why? It's going to be a good environment for stocks long term. Explain that.
We've had this is the fourth economic revolution in this country's history. The first one started in the 1790s when we had a debt crisis that was resolved by all the reforms that Alexander Hamilton put through that created stable currency and a federalist system. And that revolution, even though the government changed when Thomas Jefferson took over, it launched an expansionist revolution where the country moved westward and created a continental economy, and the economy boomed. Similar thing happened in 1860 when the next revolution happened, and we had another debt crisis. We had some initiatives in terms of infrastructure development that really kicked off an enormous growth phase for the country. And you had the Transcontinental Railroad was the key thing. The Panama Canal eventually came in. Some things that really changed the way the country transported goods, made the country a national and international powerhouse, both economically and militarily. The next revolution was the New Deal. And the New Deal was really a critical reform of the way in which the financial markets worked, and it allowed investors to come in and invest with confidence, with good information. It was always, until the New Deal, if you wanted to invest in the stock market, it was a buyer beware. You didn't have good information. Companies didn't have to disclose facts, and they could lie if they wanted to, and usually get away with it. But the New Deal changed that, and it also added deposit insurance and things like that. And when the economy stabilized after that debt crisis, in the 1940s, the economy stabilized. The boom that occurred over the next 15 to 20 years was just unbelievable. And you had 15% annualized stock market returns. And you have another revolution that's starting right now. It kind of, what led up to it was a debt crisis of 2008. All these economic revolutions start with a debt crisis and reforms that follow. These reforms, or the New Deal, kind of got out of hand. And not only did we have very high corporate taxes and things like that, but the regulation was beginning to suffocate the economy. Many of the regulations of the New Deal were very helpful and necessary, but they got to be overburdensome on business. And now as those burdens are lessened and businesses can operate more freely, and some of these tax burdens are lessened, the corporate tax cut are making American corporations far more competitive. And that some of the trade issues, some trade disadvantages are starting to be addressed. You're looking at a period of incredible investor returns are going to be available over the next generation. And this is one of those times where you just have to be in the market. The market might seem rich, but it's going to just keep on going higher and climbing the wall of worry. And you had 15% per year average returns during the New Deal revolution. I think you're going to get that over the next 15 to 20 years here. And it's a period that's accompanied with very low inflation. And a lot of that is because we're dealing with a period of time where excessive private sector debt has to be unwound. And that means basically that as consumers pay down debt, there is less pricing power in the economy, and you have less inflation. And that's what you had in the 40s. The Fed kept rates below 2%, from 1929 until 1956. And you had two big wars during that time, and they still kept rates essentially at zero, and you had no inflation during that time. And you probably have a similar situation now where there's just, and you see it, everybody says there's no inflationary pressure. They don't know why. But the real reason is that there's this debt overhang out there. And the deflationary pressure is going to be intensified by this corporate tax cut, because corporations now have lower costs. They have lower tax costs. So to the extent that they have competition that they have to deal with, they can lower their prices and still make a higher profit than they did before. And that's going to keep downward pressure on prices for a while. And at the same time, this corporate tax cut, it's not a one-time shot in the arm like most fiscal stimulus is. This is the gift that keeps on giving. I mean, companies are going to have lower tax rates to pay for as far as they can see into the future. And that's going to have a very powerful incentive effect on their investments and on the returns of their companies. So there's just a lot of reasons to look forward to very high stock market returns, unusually high stock market returns for the next generation.
Now, what are some of the risks to your thesis, right? Because that's what I always do when I have something positive or negative and you're expecting, I mean, returns, I haven't heard that, 15% annually going, 15 years out is pretty remarkable, where you're not really going to hear that anywhere. And you're not a perma bull or a perma bear. You just, you look at the numbers, you look at the markets and tell how it is, right? It's not like, I won't mention the names. They just, for the last 30 years, they've been bearish. And even if the market crashes at 80%, they're still going to be bearish.
Right.
What are some of these risks here? I mean, say if a new administration comes in, I mean, it updates to the tax code, or there's something which I think would be political suicide when you see all the benefits and people getting more money and more money coming into the country. It's going to be hard to change that, or change the perception that that's not good somehow for everyone in the United States. But do you see maybe political problems with infrastructure, or maybe we don't have that deregulation and more regulation? What is some of the risks to that thesis happening over the next couple of years?
The big risk to that thesis is not just a political change, but a political change that is retrograde, that really is determined and has the political power behind it to reverse what's already started in motion. I think that's a very low risk. I think anything is possible. You don't know how things will play out. I think it's a very low risk, because you can see, for instance, in Pennsylvania, in this open seat congressional district, a Democrat did just win, but that Democrat ran on a very moderate policy, really supporting the tax cut and deregulation and all that. And so I think what you're more likely to see is you will see political change. You will see parties change back and forth in terms of who's in power. But I don't think at this point in time anybody can take back the tax cut and get away with it and stay in power. And I think they know that. And that's why you're starting to see the platforms are starting to change of the Democratic Party. So even as the Democrat Party takes control in the future, it's going to be more moderate. For instance, when Jefferson took control in 1800, when he won a very hard-fought, bitter election, not that dissimilar from the Trump-Clinton fight, he had, for the prior 6 or 8 years, had fought hard against all of Hamilton's reforms, but when he was president, he embraced them and used them and didn't reverse any of the changes and the reforms that had been put in place, because he could see they were working and they were making a very positive impact on the economy. And I think the same will be the case with the corporate tax cut and with deregulation. Just one more thing on that is that you saw recently that the Senate passed a reform of Dodd-Frank. Now, it's not that significant of a reform, but it's a step in the right direction. And there were 9 Democrats that voted for this policy change. I think that indicates that there is still significant momentum towards deregulation, even on things that need bipartisan support. And so I really fully expect that agenda is more likely to take place. It would take a really significant, scandalous reversal of the kind of the political power structure out there right now to see that change. I just don't see that dramatic of a reversal taking place.
Yeah.
In anything I can foresee.
Yeah, no, and that definitely makes sense. So we got about 5 minutes, and I want to cover two things. One, I want to have a follow-up question because when people see deregulation and say they're not into the stock market, right? Say they have other jobs, they listen to this podcast, they read your newsletter, they want to get good stock ideas and learn about the markets. Just like kind of we want to learn about their jobs too. But when they look at and they hear deregulation, they think credit crisis. Could you explain, and again, I wanted to cover this quick because I wanted to touch up on one other thing, one sector and a couple of stocks that you like. Could you explain how deregulation is good to the point where it's not the credit crisis, but it's almost like when we had the big oil spill, right, the BP oil disaster in the Gulf of Mexico? The immediate reaction is, all right, nobody can produce oil in the Gulf. And then it comes back and says, okay, wait, a few producers. Okay, now we need to have more regular. We need to understand there's got to be more safety rules in place. And then they come up with a perfect policy. I feel like since the credit crisis, it's still that pendulum has swung to one side, and it's staying there to the point where there's people with good credit that can't get loans right now, and they have so much. There's supposed to be so much capital on their balance sheet to basically have enough money to withstand another, 30% decline in the stock market, a 30% decline in home prices, and a 10% unemployment rate or higher, which has never happened since all three of them at the same time, since the 1930s. And it seems like we're really still over there. We want to come back to the middle. So explain it, because I think when people hear deregulation, they get very nervous and they think, oh, no, the bank's going to be able to do whatever they want now, and that could lead to another credit crisis. That's not really the case, right?
No, I mean, that credit crisis that we had, a lot of that was created by some serious abuses of mortgage-backed securities, the whole mortgage-backed security securitization process, and that was really the bulk of the problem. And the response, the regulatory response, the Dodd-Frank response, was to clamp down on all kinds of lending to businesses, and especially and not just to big banks that were really the big abusers in the mortgage-backed securities issue, but it hit the small banks just as hard as the big banks. So now you have all these small banks, these community banks all over the country that are the principal lenders for small businesses, small and medium-sized businesses, and those are the businesses that are really the engine of the economic growth. That's where all the innovation occurs. And that's where a lot of the basic servicing of people's needs takes place. And these community lenders have basically had to freeze up a lot of their activity. They can't lend anywhere like they have to. They've got, like you said, these kind of crazy capital standards in terms of how much capital they have to have on their balance sheet, and they have enormous compliance burdens to show that they're in compliance with these new bank laws, and they don't have the size that, say, a Bank of America or Citibank has, to where they can spread out the cost of compliance across, hundreds of billions of dollars of assets or trillions of dollars of assets. They have to do it over maybe 5 or 10 billion of assets, or maybe even a billion of assets, and it's not economically feasible for them. And so it's caused these community banks to just shrink, to really shrink down and freeze what they're doing, and it's hurting the real economy in a very big way. We take away that burden where businesses that have good investment opportunities can get credit. You'll see a lot more growth of investment, a lot more growth of employment, a lot more growth in wages. It's going to help all the way around. The regulatory burden just, it was an overreaction in Congress, and it's an understandable overreaction, but now you have to kind of swing it back to something that makes sense. Let's fix the problems that really need to be addressed. You probably do need excessive capital burden on companies like Bank of America, because you don't want to have to take the risk of bailing out a massive bank. But all these small banks that aren't a risk to the economy, let them operate like a normal company. I think it only makes sense.
No, I definitely agree. And okay, so let's get to the final thing here, because there's one sector that you like that I like that I would say that I was definitely wrong on. It's weird because I was right, and we'll talk about oil here, right? So I thought I provided unique, detailed analysis because I'm fortunate to have great contacts in this industry who drill all over. I've been in every shale area and understand that below 40, it's basically, we can't scale oil. We can't produce at a massive scale. So you're seeing oil come off the market tremendously. So when we were at 40 for a little while. I'm like, oil prices are going to go higher. I thought it was a good opportunity to buy some of these stocks, specifically 2 or 3 of them within a small area in the Permian Basin where you could produce at $30, $35 a barrel. And they were leveraged, though. They pushed out a lot of their debt. They survived. They did great, earning cash flow. But a lot of stocks in this industry got crushed. And they're still trading at levels that are very surprising, considering we've seen, a 20-25% dump in oil prices, yet these stocks have been down like 10-15% almost over the same time frame. You're a big energy guy as well. Talk about that industry, because it seems like that's one of the few, because when we say, oh, it's good, cheap industry, gold and uranium and stuff like that, which who knows, but this is an industry that you're seeing corporate profits, free cash flow rise. The stock prices are still relatively cheap.
Yeah, it's amazing. It's amazing, Frank. And I completely missed one part of this, I have to say, and that is I did see the profitability improving, and I was really encouraged when I saw how innovative some of these companies had become at cutting some of their costs. So where at $60 a barrel oil, they used to maybe be break even, maybe losing a little bit. Now they're making a good profit at 60, and at $3 in gas, they were losing money, and now they're making good money. So the companies are now almost universally running healthy profits and healthy cash flows, positive cash flows. But some of these companies are really, their stock prices have been crushed in the last 6 months. And I think where you look at it and you look at the companies that have been hurt and the ones that aren't, the real differentiator is leverage. The companies that don't have any leverage are trading at like a 15 PE, which isn't a really high PE, but it's reasonable. But I take a company like, and that would be say like Cabot Oil and Gas, it's like a 15. A slightly more levered company like it is 11 PE. But if I take a company that's pretty high levered, maybe 1.5, 2 times the market cap in leverage, like Southwestern Energy, that's at a 5 PE. And then if you go to a more levered company like Chesapeake, it's more like a 2 times. It's like a 4 PE. Sanchez Energy, which I like Sanchez a lot. It's got incredible great growth of profit expectations. It's trading at a 3 PE, and it's about 3 times levered. And these companies still present tremendous opportunity, but the way in which they're going to make a profit for investors is they have to delever, because investors are punishing leverage right now. If they take their profits and they sink that into paying down their debt, they should see their stock prices rise significantly. But that's what they got to do. They have to really be disciplined about making positive cash flow and reducing their debt, and then they'll get some really performance out of it.
Steve, could you explain to the average investor what 3 times leverage means, and maybe for industry standards as well, because they might say, "What's 3 times leverage or 4 times leverage? What's the industry?" Could you just explain? That's something you cover very thoroughly.
Yeah, it's really hard to. Sometimes it's hard to look at your book value, because these companies have written down so many assets that they might even have a negative book value. But I can look at where say the market cap of the company and where the market thinks their assets are worth, and so that's why I'm kind of using the multiple based on the market capital as opposed to debt to equity in some of these cases. And a company that has 3 times levered has basically 3 times as much debt as they have investment capital in there, and so there's not a lot of margin for error for them. If oil prices drop significantly and they start producing losses, they may not be able to meet their debt service requirements. And so 3 times is pretty high. 1 time levered is not that high, because, in most cases, if got any profits at all, they'll be able to meet the interest payments. But so basically, it's just a very rough and simple metric to measure how big the debt burden is for these companies. And,
now, I want to ask you something, Steve, too, on this too, because we have about a minute left. Is there a good opportunity? Because when I do research on these companies, and that was a perfect storm, which I highlighted in 2014, 2015, why I was telling everyone you sell every single oil stock you own, because they were able to keep their profit margins higher because they were hedging oil prices. And a lot of those hedges were from oil when it was $70, $80, $90 a barrel. Once those hedges came off, now you have oil much lower. Now, not only do you have a massive amount of debt to service, but you're not making profits, and free cash flow is down, it's negative, and result in a lot of bankruptcies. However, during that period, a lot of these companies restructured their debt. So when people look, say, on some of Yahoo Finance, see an oil company, they'll see the market cap $100 million, they'll see maybe $40 million in cash, and they'll see $2 billion in debt, and they go to the next company without looking at free cash flow and without looking at when that debt is due, because sometimes 80% of that debt could be due after 5 years. Is there a way is that something that you should look at if you're investing in the oil industry, where, you're buying the leverage companies and they've been punished, but those are the ones that are cheapest valuations, trading at low earnings. They generate high free cash flow, but if you could find a way to see which companies have pushed out their debt, and obviously the interest rates on the debt and how much it costs to service that debt, it could be a real good opportunity to get stocks. Not only that would go up 50 or 100%, but if oil prices went higher, these could be massive, massive winners from these levels, right?
Yeah, that's exactly what I've looked for in my picks in the industry. Is I've looked for companies that have pushed their debt out 3 to 5 years before they have significant principal repayments, so that they really only have to meet the interest part of those burdens in their term, and they have also hedged at least out, for the next year to 2 years, significant amount of their production, so that they're assured of having profits in the near term, and at least had some of their hedges out over the next 3 years, so that they know they can meet the debt. They'll have some profits, even if oil prices drop a lot. They'll have some profits to pay that debt service based on the hedges that they've set, and they've all been able to set significant amount of hedges in this environment, because oil prices, they've been trading above 60 for a long time. These are very profitable levels. Gas around $3. These guys are making money at $3 in gas, and they have been setting a lot of hedges, and they're pretty well protected in the near term. So yes, things can go wrong for these guys, because there is still, you can't hedge out forever, but in the near term, there is some clear sailing, and they also are running very high profits right now.
No, that's great stuff. And listen, I always want to try to keep these interviews a little bit shorter, but there's just so much interesting things, so much interesting stuff to talk about. And we'll end with this, Steve. If someone wants to find out more information on your newsletter, at Vigilante Investor, how can they do it?
Go to vigilanteinvestor.com, and you can read about me there, and you can follow me on Twitter at VI Investor.
And that's perfect. Well, thanks so much for doing this interview, Steve. For me, hopefully it comes through. I always say this podcast is about you, not about me when I'm talking to my listeners. For me personally, every time I talk to you, I learn something new. Every prediction you have is always backed up by tons of facts. Whether you agree with it or not, it just makes you think more, makes you research more. And that's something that I love to do, and hopefully that comes over to the audience as well. So I really appreciate you coming on, man.
I appreciate your time, Frank, and thanks to all your listeners for hearing me.
Man, I love my job. Love doing this podcast. And where else can you talk to some of those brilliant people out there? I'm sure a lot of you don't have to agree with everything Steve says. I mean, 15% annual returns over the next 15 years, that's interesting. And that's great. That's why I said, hey, what are some of the risks to your thesis? But I love people who come on here to just really challenge your beliefs, challenge your thesis, or say something when you're like, wow, that's a little crazy, but they back it up. We have so many people that make, you see on TV, they'll come in, Bitcoin's going to $1 million. We heard how many people, Bitcoin's going to $1 million. Where's your analysis? No analysis, just going to $1 million. And you can say whatever you want, how crazy it is, but when you have the research to back it up, it just makes you think a little bit. It makes you dig a little further. And Steve's not, Yeah, he's not, if you have Jim Cramer, you watch him on TV, Jim is great at something like Ronald McDonald. And he understands the entertainment factor, right? That you want to draw more listeners in because you're going to teach them. And if he just says, well, McDonald's is trading at 20 times earnings and they have a new menu item and it's a good buy, you're not going to have a lot of people watch that. Now you turn into like Louis Rukeyser, who's smart, but boring, right? Nobody really wants the show anymore. I liked it because I'm a diehard. It's almost like reading Muhammad Al-Arian's book. Right? He's a brilliant economist. I enjoy that. 99% of the people in the world don't. But then when you have someone like Michael Lewis could appeal to a massive audience because he made statistics interesting by telling a story about Billy Beane, Moneyball, and stuff like that. So when I have a guy like Steve come on, it's important where you might get lost in some of the numbers, and I try to put things in perspective for you, and I'll tell him, what does 3 times leverage mean? But I love that people back up their claims and what they say. And that's why I love this job, where it's not just about me and, Frank Curzio said this and you have to listen. Yeah, I'm not always going to be right. I can be right more times than I'm wrong. If I'm not, I should get another job. But that's what helps me become a better stock picker, by interviewing guys like this, by listening to people out there, listening to other people who challenge you, right? We look at Michael Alkin, I think is brilliant. And he thinks the market's going to come down tremendously. I read both of their research. I mean, Alkin's obviously, working. You have Koomar, but you have 2 guys on different ends. Use them both. Like, people are like, well, you have Alkin on saying the market's going to crash, and then you have Koomar on saying the market's going to go up 15% annually. You use that to your advantage. And would you rather I bring on 75 people in a row who are libertarians that say the market's going to crash, and you go buy a cave? What is that going to do? And you see so many websites like that. Like, I love the research on Zero Hedge, but it's so biased to the negative all the time. They'll take the most positive story, no matter who it is. If Obama rescued a baby, they'd find it's about to drown. They'd find something negative to say about it and how it's terrible for the stock market. It's just, but yet they have great research on that site. So you want to be able to listen to both sides of the story. It doesn't mean you have to like that person. They can still have good points about things. And trust me, it'll make you a much better investor when you do that. Listen to more people. That's why I love my job. It's so many different opinions. Not that, get a lot of good free stock picks as well. Okay, let's get to my educational segment. If you haven't heard, just had one of the greatest upsets in sports history. For the first time, another 16th seed, UMBC beat a number 1 seed, which is Virginia. And Virginia was not just a 1 seed. They were the number 1 seed. And seeded as the best team in the entire tournament. And not only did they lose, they got the crap kicked out of them. I mean, they lost by more than 20 points. And to put that in perspective, Virginia was favored to win the game by more than 20 points. It's insane. And you're hearing, this might be the greatest upset in sports history. You might debate that and say, I don't know. It was a miracle on ice. Mike Tyson, Buster Douglas. You can keep going. Some of the biggest upsets ever. But here's why you have to take this into consideration. I mean, you look at UMBC hit a buzzer beater against Vermont in their conference tournament, right? So if you win the conference tournament, you make the tournament automatically. Vermont was favored to win that game. They blew out UMBC 2 times. I think they beat last time in February by 28 points. So UMBC hit a buzzer beater, and that automatically got their bid in the tournament. So this is a team that's ranked 188 out of 3-something? I mean, you have the top 64 teams in there. Well, it's top 32, and then, all the winners of the conference tournaments. And their recent loss, was to Albany. They lost by more than 40 points. Albany. And they lost to Stony Brook. I mean, Albany and Stony Brook, if you could dribble a basketball and chew gum at the same time, you're going to play on those teams. You make the team. I don't live too far away from Stony Brook when I was in Long Island. But, I mean, it's incredible. And I watched this game, and here's the point I'm getting to, guys. I know most of you are sports fans, and most of you is college basketball. Some of you aren't, but follow me here. It's very, very important. Because when I watch this game, looking at Virginia, I've seen them play a lot. They're a great team. And they crushed North Carolina, Duke, Clemson, all the great teams in the ACC, dominated the division. But they're a defensive-minded team, and they play slow, which means they don't press, score a lot of fast break points. They don't run a lot. They play a style of basketball that's slower, different. You could say almost non-athletic. But they managed to outwit teams since they have few turnovers. They have lots of steals, backdoor passes, very smart, moving the ball really quick. Just fundamentally sound. And that worked. It worked the whole season for them. But the UMBC game in the first half, you know what? This strategy kind of worked. The score was tied at 21-21, very, very low scoring. So you have Virginia and UMBC kind of playing like the same game, right? You kind of want to lead and dictate Virginia dominating, but it was 21-21. It's very low scoring. But then second half happened, right? UMBC started hitting shots like crazy, hit like every three-pointer they took. One of their players, Jarris Lyles, got hot. I don't know if for those of you who basketball, I mean, this guy could have just heaved the basketball from the opposite baseline. It would have went in without even hitting the rim. Just get on that. I mean, this guy was on fire. It was incredible. So then we have the 12-minute mark, and all of a sudden UMBC is suddenly up by 16. Hear me out, guys. I'm getting to the investment point here. And what did Virginia's head coach do? It was Tony Bennett, which, by the way, I said I warned you. He's not a big game coach. He's not proven. He was number one seed in the past, lost early. He really hasn't done anything in a tournament ever. So it's hard for me to, so I thought Kansas State had a very good shot at beating them. But they never made it to that game. Kansas State's in the Sweet 16 now. I also warn you that this could be the year a number one seed loses in the first round, which I don't say every year. However, I got to take zero credit since three of my top four teams, including my winner, UNC, North Carolina, already lost. But we get back to the coach of Virginia, the down 16 with 12 minutes left. And what did the coach do? He didn't change a thing. His team was walking the ball up, wasting time. They let the guards of UMBC take 25 seconds off the clock, walk the ball all the way up the court, get past half court so you don't get a violation, and just sit there and dribble the ball, and they just sat back. Down 16, 17, 18 points. They didn't press them. They didn't do anything. Remember, this is a team, right, UMBC, that's never been there before. They're nervous. They had like 4 stupid turnovers late in the game that didn't really matter because they blew them out anyway. But why are you not pressing full court? Why are you not double-teaming Lyles, who scored, it seemed, 20 points in a row? I let someone else shoot. Those guys are nervous as hell. They're not used to this environment. Let them make mistakes. And basketball, like most sports, is about confidence. And Lyles was not missing, so get the ball out of that guy's hands and let someone else try to go try something different. Press. Put pressure on them. They're going to get nervous. They're going to have turnovers. And all you need is 1 or 2 turnovers, and that team could fall apart immediately. You see it happen all the time. Teams just collapse. And you're the number one team in the nation. They're supposed to lose. They go in there like, oh, man, they're looking at the clock like every minute past like 10 minutes left. Oh, yeah, we're still up. We're still up. We're still up. It's just horrible coaching. Now, why is this so important? What does this have to do with investing? It's pretty easy. Let's take David Einhorn, for example. Einhorn is a hedge fund legend. Called the Lehman collapse. Everyone thought he was crazy. I mean, Lehman was worthless. Allied Capital made money of that collapse. His returns were incredible over a 15-year period. Annualized gains close to 20%. He's sitting on top of the world, highest paid hedge fund, everything great. You look at Einhorn, he's one of the great short sellers. And he's also known for being a great value investor. And you know what? Over the past 5 years, value investing, short selling, 2 of the worst markets to be in. And value investing. I mean, how many, even Einhorn came out, value investing is dead. You can't invest in value. Shorting any stock. I mean, stocks going higher, not even based on valuation, right? You look at some of the FANG stocks, you look at NVIDIA, take 2. These things are seeing it's a growth market, momentum market where, you just got to get run over trying to short these names. And we have a market where, I'm not going to say it's pretty easy, but kind of easy to see interest rates were going to remain at historical lows for a long period. I mean, you just had to listen to the Fed on that. I mean, we all thought it was going to go higher in 2011. We said by 2013, maybe 2013, Fed's like maybe 2015. They'll kind of let us know that, hey, the markets aren't on great footing yet. We're going to keep interest rates low. To have interest rates low, we also have super low inflation. Okay, inflation is not easy to predict. Everyone thought that inflation would surge with all the stimulus, low interest rates, and it didn't. But without, or even say with low interest rates and with low inflation, that's the perfect market, the perfect recipe for growth. That's when growth excels. That's why you're seeing technology go through the roof. You're seeing companies that have that growth component, that adding the cloud to their business, big data analytics, a lot of these technology companies. It's a great market for growth, which is what Einhorn is not great at. I'm not saying Einhorn should have saw this coming. I mean, we could all say, oh, we should have saw that coming. You don't. But you know what? He should have been able to really hedge his short exposure, maybe add a little growth in his portfolio. Instead, he shorted Green Mountain Coffee, got wrecked. He shorted Amazon, got destroyed. He shorted Tesla's, get destroyed. He shorted Netflix. So you have a professional investor who's great. And I think he's going to make a remarkable comeback because he does great during volatile periods. And we're going to see volatility over the next year or so. I'm not picking on him here. This is a point. Because I wish I had as much money as Einhorn. But Einhorn failed to change his investment philosophy. He didn't adjust. He didn't adapt. And he paid the price. Or shall I say, the investors' his fund paid the price, right? I'm sure Einhorn still has plenty of money in his bank accounts all over the world. Now, where am I going with this? In 2017, I was having a tough year at Curzio Research Advisory. I was buying beaten up value names with insider buying. They had short-term catalysts. I'm not trying to catch a falling knife here because they say insider buying, these stocks trading close to book value. Love to see the insider buying. And they had several growth catalysts that were going to kick in 6 to 12 months, which I always see. It was a good style of investing for a little while. But then value stocks started getting crushed. I also bought some energy stocks that looked fantastic because I knew oil prices were going to surge. Talked about this, Steve Koomar. Oil prices surged. Oil stocks, especially ones that were high leverage, got nailed. Even though they pushed their debt out. These are great buys. Got stopped out on some of those. I mean, it looked like it worked. The style looked fantastic, but it wasn't working. It wasn't working. And I was losing people money. The only thing that was working at the time was growth. So I started investing in growth stocks. A fair warning, I'm going to give a couple away here, but they're much, much, much higher than the prices that my subscribers got in. So I don't want to get any emails at all. But I recommend DXC Technology. Stock surged over 30% since May. I recommend Amazon in October. I can't tell you how many negative emails I got. Am I buying your newsletter? Amazon, what are you, crazy? Stock's up 60% for us. I recommend a cloud company called MindBody, up nearly 50% in 5 months. Again, I am giving away a couple of picks here because they're trading insanely higher than my buy up to prices. The current subscribers relax a bit. I don't recommend buying any of these names right now. Maybe on a pullback. Amazon does look attractive here. But we're up a lot on these names, and I'm providing an example because it's going to make you a better investor. Because my point is, if you're a coach, and you're a good coaches are able to adjust, and they adjust mid-game. If something's not working, they change their strategies. They mix things up. Look at Nick Saban benching his starting quarterback, Jalen Hurts, in the second half of the national championship game for a freshman quarterback. Are you insane? They were losing 13-0. 13-zip. And Hurts was 3 for 8 passing with 21 yards. But he was playing terrible. And I saw, I don't know if everybody saw it, there's like 3 or 4 wide open guys that he didn't even see. He chose to run instead. I mean, he was just all discombobulated. It was terrible. Hurts, by the way, was 25-2 as a starter over the past 2 seasons at Alabama. 99% of the coaches would have never made that move. They would have just been like, you know what? You're the one who got us here. You're the one that's going to do it. And you know what? They would have lost that game. You know what Saban did? They were trailing at half. Looked terrible. He benched a quarterback, put in a freshman quarterback, whatever his name is, Tagovailoa, whatever. Went 12 for 24 passing, 166 yards, 3 touchdowns in just the second half. Alabama won that game 26-23 because of that adjustment. He knew it, he saw it, and he made the adjustment. As an investor, you need to be able to switch it up. You can't have an investment strategy of picking value stocks when value's been out of favor for 6 years because you're going to get crushed. Growth will be out of favor soon, maybe for 5 straight years. That'll be, you'll be buy value stocks. Stocks that are dirt cheap, generate lots of cash flow, trading at a below market multiple, generate lots of free cash flow. Maybe the market's become glued to technical levels where technical analysis makes more sense than fundamental investing. Maybe mining comes back into favor. But I see this all the time, and I'm not going to mention the guys because you know them. They've predicted a crash for 15 straight years. They took credit for the last crash because they've been calling crashes basically for 20 years. But they've been bearish the whole entire time without even looking at the fundamentals, the economics, what's going on, low inflation. We have a government that said, we're backstopping everything, so don't worry about losses. And, we're going to keep interest rates low and stabilize the banks. You want to talk about the ultimate bull market ever? I mean, it's like getting the USA basketball team with Jordan and Magic and Barkley on it and playing like a high school team. The stocks are guaranteed to go higher. The Bears ignored it. You have guys telling us the dollar's going to crash for 7 straight years. How long have we heard that? The dollar's going to crash. It's going to be a terrible environment, which the thesis makes no sense. Whenever things are terrible, the dollar goes higher. That's the safe haven for the world. Maybe it'll happen 2 generations from now. It's not happening anytime soon. Don't listen to those people. Believe me, they already crushed you for the last 10 years. Gold bugs telling us gold prices are going to go to $5,000 an ounce since 2012. And that real interest rates, as long as they remain negative, it's good for gold. Real inflation rates is inflation. It can count. It's interest rates on top of inflation together. And in the meantime, real interest rates have been negative, 2012, 13, 14, 15, 16, 17, and gold prices, where did they go? Well off their highs. Gold stocks are down 60%. Instead of after 2012, 13, 14 saying, okay, this trend's not working, they're pounding the tables. I go to these conferences. I'm debating these guys right next to them. I hear it all the time. Are you kidding me? Well, real interest rate, what are you talking about? You've been telling me that since 2013, 14, and your stock's down 85%, and you're still saying that's the reason gold prices are going to go higher? It's obviously not the reason. Give me a different reason or find something out. Figure it out, learn from your mistake. But what you're telling me is I shouldn't even go near your stock or any. If that's your thesis and it hasn't worked and you're maintaining that, why should I follow you? Why should I follow your advice? It's important that you understand this, guys. Try to be flexible. Don't be like the coach of Virginia who changed nothing and watch his team make history getting blown out by the 188th ranked team in Division I basketball. Again, there are like 300 teams. So learn different investment styles. This podcast offers you that opportunity. I'm always interviewing fascinating people with unique strategies, different from mine. And Horowitz, technical analysis. I'll throw some shorts in there. John Petrides, a value guy, growth a little bit. Mark Lichtenfeld, dividend income. We just heard from Steve Koomar, top-down approach, looks at economics and filters it down to which sector and eventually what stocks he's going to buy. You have Navalier, growth momentum investor. Chris Mayer's a value guy. I mean, these are great strategies. They've worked at one time or another. And no strategy works forever. It doesn't. But being able to understand the market conditions and switch things up and learn and not be stubborn, that's the key to being a great investor. I'm fortunate to know all the guys I just mentioned and follow them for years, respect them, talk to them. And they also share their favorite ideas with me, just like I share my favorite ideas with them. So this podcast is awesome. Create a product like that. The best investment ideas from everybody. That'd be fascinating. Different investment styles. But that's a smart way to invest, guys. Don't be stubborn in your ways. Learn to adapt. Believe me, I'm speaking from experience. I don't want you to make the same mistakes I made, being stubborn, closed-minded. You want to learn from those mistakes. This way you guys make a lot of money, have a great retirement, pay for your kids' college, buy that new boat, that new house, whatever it is. That's what you have to think about when you're buying somebody's newsletter, or if you're listening to certain people in the investment industry. That's what you have to think about. Not some stubborn guy that's just going to predict all these bad things that haven't impacted the market for 10 years, but I'm going to just keep saying them to entertain you, even though you're losing money, and he's entertaining you, so you're just going to keep listening. Just be very careful of that, guys. Very, very careful. All right, 2 things here. Check out my Curzio Research Facebook page. I just posted a pretty sick video. My older subscribers may not think it's so funny since I'm doing something really crazy with my daughter. Let's just say for those of you who think becoming a lifetime subscriber means it should be for my lifetime instead of yours, right? Which a lot of my older subscribers say. And the average newsletter subscriber is about 70 years old and I'm about 25 years younger than that. You may want to rethink this position after you see this video. I'm just saying. So it's very interesting. If you want to take a look at it, it's my Curzio Research Facebook page. Also, real quick here, if you know we're hiring, we're growing, we are looking for copywriters. Experienced copywriter. Anyone's interested, email me, frank@CurzioResearch.com. That's frank@CurzioResearch.com. Our pay is among the highest in the industry, so we pay very well. So if you're interested in working for a fast-growing, pretty cool company, I like to think, we're going to have an unlimited amount of amazing ideas to write. Trust me on that. Something you're interested in, send me an email, frank@CurzioResearch.com. The best way to get in touch with me. Okay, guys, enjoy the rest of March Madness. Watch out for West Virginia and Kansas State. Two teams I think go to the Final Four. Kansas State, especially if they get their best player back, Dean Wade. And my bet of the week, I hate saying this. I hate it. I hate telling you this. I really like Kansas. So KU looks great against Clemson, laying the points. I know Clemson blew out everybody. They look great. KU looks terrible. I will never say this because I hate jinxing it with Kansas, but Devontae Graham loves games like this. He played terrible last game. He always gets up for really, really big games, especially after he plays terrible. I think there's like a 1% chance of Clemson playing that good again, where they hit, more than 50% of their shots, lit it up. And KU is not Auburn, which Clemson blew out by 30, 40 points. And they're going to be really pumped, basically in front of a home crowd. They're going to be playing pretty close to home. So I do like Kansas this week as a bet. So that's it for me. Thanks so much for listening. I'll see you guys in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.